I published a new uh, post at Google's Blogger website yesterday discussing my trades over the past few days. I started publishing blogs there in October 2008. A link to the post can be found at my YouTube profile page. Just click South Gent and it will take you to that page for anyone interested. I discuss in that post buying 5 municipal bonds rated AA2 by Moody's, my first purchase for in several months of a municipal bond, 10 Treasury bills at last week's auction, and 2 corporate bonds maturing in 2029. I was a net seller of stocks and stock funds, but only by about $345. While I will generally maintain a position in stocks anywhere from 200 to 250, the allocation overall is small at around 8% of my total portfolio held in brokerage accounts. Most of the purchases that I discussed in this last blog were equity REITs who have declined in price and consequently increased in their dividend yields. I am mostly averaging down in those purchases. They are out of favor with institutional stock investors. The 2 largest sales were an elimination of a duplicate position in the energy and production company APA due to my concerns about energy prices remaining low for longer than I previously expected. And I also eliminated a 17-share position in GMAB, which I called a lottery ticket, with a Danish drug company that just announced last week an $8 billion cash acquisition. I do not favor growth by acquisitions in the pharmaceutical industry, given a long history of many failures or overpaying for acquisitions in that industry. And I give an example of a history of Pfizer's acquisition starting in 1999, where the acquisition cost of those were more than twice the current market capitalization of Pfizer, and yet they continue to pursue a growth by acquisition strategy. The price movements of precious metals, Bitcoin, the US dollar index, and intermediate term treasuries are all sending uh, consistent messages that the U.S. economy is not well. Stock investors are sending a different message that the economy has not been this good ever as major stock indexes hit new highs. It is a blue sky almost forever, according to the stock investors. On January 21st, 2025, gold closed at $2,754 per ounce and at $3,887 yesterday, up 41.1% so far during Trump's second term. On January 25th, 2025, Bitcoin was at 106,126 and it was at 123,332 earlier this morning when I last checked. On January 21st, 2025, the 10-year Treasury closed at 4.57% and at 4.13% last Friday, October 4th, 2025, as inflation has continued to move slightly higher, indicating, in my opinion, a flight to safety calls for the intermediate and longer term bond rally in Treasury notes and bonds. The US dollar index has a symbol of DXY, closed at 108.06 on January 21st, 2025, and at 97.71 yesterday, a 9.58% decline in the US dollar's value against a basket of six foreign currencies weighted in euro so far this year during Trump's second term. The decline in the USD's value against foreign currencies increases the cost of imports on top of the existing Republican tariff taxes. The price movements of all of those preceding that I discussed asset categories are consistent with one another, in my opinion. I view Bitcoin and gold to be primarily alternative currencies, and consequently, the surge in value this year is consistent, in my opinion, with the decline in the value of the US dollar so far during Trump's second term. I would add that Trump's chief economic advisor, a guy called Stephen Moran, who was recently appointed by Trump to the Federal Reserve, has represented that the Republican tariff taxes would increase the value of the US dollar against foreign currencies, which would absorb a major part of the tariff tax cost for US importers. I have a video discussing that issue, which I will link in the more section below. Moran may be the only well-known economist who believes that high tariff taxes paid by U.S. importers do not increase consumer prices to any meaningful degree. So which investors are right in their pricing decisions now? Stock investors or the investors in the other asset classes that I've mentioned here early in this video. The blue sky scenario envisioned by stock investors is not consistent with a current U.S. job market that has ceased creating new jobs and has turned negative in job creation. ADP reported that private payrolls declined by 32,000 in September. The August number was revised from an extremely anemic plus 54,000 to a negative 3,000. The recent BLS reports confirm that the labor market has rapidly and significantly deteriorated in the last few months. The BLS jobs report for September was not released yesterday due to the shutdown. If Trump carries through with his threat to fire more government employees using the shutdown as an excuse, that will add to the ongoing weakness in the U.S. jobs market. Inflation is rising slightly, but it is not yet back into what I define as problematic territory, which is a persistent rise above a 3% in the annual PCE price index. I noted in yesterday's blog post the ICM September Manufacturing Index was reported in contraction territory for the 7th consecutive month, and the ISM Services Index, which has been declining this year, was reported at 50 in September, down from 52 in August. The new orders component of the service index declined to 50.4 from 56. That is important. The employment component in the service index remained in contraction territory at 47.02. Any number below 50 indicates an ongoing contraction. The U.S. is primarily a service-based economy. While consumer spending is holding up, which is a positive, I believe that a considerable amount of that spending over the past several months, particularly on expensive items like cars is front loading by consumers of what would have been bought in the future in order to avoid and to beat the Republican tariff taxes on imports. It will take time for the Republican tariff taxes and the decline in the US dollar's value, which is significant, to show up in consumer prices, as I have been saying since early this year. I do not expect all of the prices to be passed through until later in 2026. It will be a gradual process that manufacturers that can afford to do so are currently absorbing some of those increased input costs, and they also imported far more product than they needed, stored the product in warehouses, and only gradually are taking those products out of warehouses that they imported prior to the tariff taxes taking effect and selling them in the economy. So we will see whether the gold or Bitcoin or U.S. Treasury investors and bond investors in general are correct in their assessment of what is happening now, or stock investors. But I do not see any reason at this point in time to go with the stock investors' blue sky forever scenario.